Then there would be address by President ICSI, Sri Ashish Garg. Then there would be a special address by Joint Secretary and CEO IPFS, Sri Manoj Pandey. And then this would be followed by panel discussion with the experts on the subject. We'll begin with a brief introduction of participants and panel members. Sri Manoj Pandey, as is well known, is the Joint Secretary with Ministry of Corporate Affairs, Government of India, and holds the post of CEO of IEPFA. He has been providing the leadership to IEPFA as its CEO and taking it forward in its mission of investor education and investor protection. Sri Ashish Garg is the president of ICSI. He has rich experience of legal and company matters and has been providing leadership to the ICSI for some time. We have three experts today who are quite well known in their respective areas of expertise. Mrs. Monica Hallan is the author of the best-selling book Let's Talk Money and a consulting editor with Mint. She is an MA Economics from Delhi School of Economics and in the journalism studies from University of Wales. She has worked across media organizations and run for successful TV series. Mrs. Hallan is based in New Delhi and was a Yale World Fellow in 2011. Sri Gopal V. Kumar is one of the members of IEPFA Authority. He is a practicing actuary and management consultant who has been working for more than 24 years in the area of. He has been widely quoted on banking, insurance, and economic issues in the print media and digital media. Sri Anil Gupta is a partner with Microsoft Consultancy, working in the domain of digital financial services, payment, and distribution. He is a hands-on development banker and technology manager with over 2 decades of experience in India, China, and USA. He specializes in due diligence of financial institution business planning, safe technology management, and technical assistance design. With this, I welcome everyone once again, and I would invite Sri Ashish Garg for opening address by him. Mr. Ashish Garg.
Thank you so much. Respected Shri Manoj Pandey ji, Joint Secretary, Ministry of Corporate Affairs and CEO of IEPF Authority. Professor Kamakhya Singh, Chair Professor IEPFA, IICA. My other panelists, Monica ji, Anil ji, Gopal ji, and all our viewers. A very good afternoon to all of you. The topic of today's webinar, Financial Decision Making During COVID Crisis, Unleashing the Importance of Investor Education, is quite apt and timely. The word investor, while always has brought to our minds images of stock market and hordes of people shouting at the top of their voices. Well, yes, this was the scenario of any stock exchange until a few decades ago. With advancement of technology, it seems both magical and intriguing as to how the markets work on the click of the button and slight touch on the mobile screen. Warren Buffett, renowned for his investment skills, said, and I quote, "We don't have to be smarter than the rest. We have to be more disciplined than the rest." While he might have said these words, keeping in sight his expectations from fellow individual investors, yet I believe his words would fit completely at a macro level as well. It is not only the individual investors who need to be disciplined in his buying and selling activities. Rather, the entire stock market is required to be disciplined. And I believe it is for the purpose of rendering this discipline, the SEBI has been put in place. Likewise, IEPF Authority has been entrusted the responsibility of administration of the Investor Education Protection Fund. Make refunds of shares, unclaimed dividends, matured deposits, debentures to investors and to promote awareness amongst investors. We all have witnessed that under the guidance of Manoj Pandey sir, IEPF has worked day in and day out for the ease of living. Ease of living means they have disbursed crores of rupees to the investors during this lockdown period also. And I am happy that our company secretaries have also played an important role to work under the aegis of IEPFA. While the first is a financial and technical function of the authority, the second comes across more as a social responsibility. And it is for the accomplishment of a second objective that ICSI 2 has extended is unstinted support for strong, educated, informed and aware investor base and achievement of the highest standards of governance in the Indian corporate sector. Even further, sustainable growth and development can be achieved with an equal focus on all the sectors contributing towards the growth of Indian economy. So many national and state programs have done by the IPF, and even the Minister of State of Corporate Affairs and Finance, Anurag Thakurji, has appreciated the efforts of IPF and especially the Manoj sir for this organization effective, hassle-free and very proactive. The pace of achieving the vision of New India by 2022, when we celebrate 75 years of India's independence, may have slowed down a bit during the current pandemic. But with the initial fall during the early part of April 20, the stock market has shown a continuing strength. Even today, it has crossed 40,000 mark. The stock market has been factoring its expectation of the times to come and the hope that the economy would rebound in the short term. With the lifting of lockdown in a phased manner and resumption of modest economic activity in many parts of the country, the unemployment rates are set to go down and industrial production are going to gather place. I just remind one story on stock market, which everyone we are aware about the selling of monkeys. It's very apt that once upon a time a rich man from the city arrived in a village. He announced to the villagers that he would buy monkeys for 100 rupees each. The villagers were happy that there were hundreds of monkeys in the nearby forest. They caught the monkeys and got them. Rich man bought 100 monkeys, paid 100 for every villagers. Then they have said the rich man offers 200 rupees for every monkey. The villagers were ecstatic. They went to the forest, set up traps and caught the monkeys and got them to the rich man. Few days later, the rich man announced he would pay 300 per monkeys. Now there were no monkeys in the forest, but still they have tried to find out. And one day rich man announced he would buy the more monkeys at 800 rupees. The villagers could not believe it. In the meantime, that rich man went to his city and he prepared a trap, and his manager has come into the stepped in. He made an offer to the villagers and villagers could not refuse, pointing out that whatever all the monkeys the rich man had caged, he told to the villagers that he will sell all monkeys at 400 rupees and you can sell them back to the rich man at 800 rupees. When he comes back, and you know what happened after? There were no manager, no rich man has came back, and villagers were bought all the monkeys at 400 rupees, even by borrowing the money, even by spending all the amount, whatever the saving they have. This is the apt story of the stock market. If you are not aware, they were a low price stock which no one interested to buy. A few rich men will suddenly start buying it. The stock price will rise because there are suddenly a lot of buyers and very few sellers. Classic case of huge demand and no supply, like the monkey in the forest. Now the inexperienced investors hoping to double and triple their investments get lured into them, and finally the big players who had bought the stock early when no one wanted it sell it back to inexperienced investors at high price. Friends, this is where the investors' education is important. Moral of the stock market stories: invest only in quality companies that are selling products which customer love and use. Don't be greedy. There is no quick money in the stock market or in the life. Capital market in any country plays a pivotal role in the growth of economy and meeting the country's socio-economic goal. The dream of becoming a $5 trillion economy seems a distant one as of now. But the pace of the financial market in very recent past is bound to fuel the economy in the achievement of this dream. And it gives me a feeling of immense pride that I am from an institute which has time and again portrayed its solidarity, once again in standing true to its commitment as the right arm of regulatory authorities in pursuing of their various initiatives which pave the way for the strengthening of the governance structure in India. I am sure that the deliberations of today's program would give us a forward-looking view on the financial decision-making during this COVID crisis and unleashing the importance of investor education and to discover the new dimension of fostering the growth and development of Indian capital market. Thank you so much.
Thank you for your initial address, Mr. Garg. I would now invite Sri Manoj Pandey, Joint Secretary and CEO of IPFA, for his special address on the subject. Sri Manoj Pandey, please.
Dear Shri Gopal V. Kumar, Member IPFA, Shri Ken Singh, Chair Professor IPFA, Ms. Monica Alan, Consulting Editor and well-known face of media as far as finance and economy is concerned. Ashish Garg, President ICSI, and Shri Anil Gupta, Partner Microsoft. A very good afternoon to all of you. Thanks to Shri Ashish Garg for his kind words. I would in my remarks put across certain background facts and also propositions, and then also inform the participants in this webinar, both who are part of the panel and also part of the audience, about the activities that are and have been undertaken by Investor Education and Protection Fund Authority. Friends, as we all are aware, in March 20, World Health Organization officially declared the coronavirus outbreak to be a global pandemic. Almost all countries across the globe have been affected. This outbreak has had severe impact on world economies and human lives. All the governments practically, in order to save precious human lives, took many steps, including lockdown measures. As a result, economic and financial activities also got impacted. Now, the uncertainty of this pandemic and its associated financial economic losses has caused the market to become slightly uncertain, unpredictable, and volatile. As Mr. Garg had just mentioned, that Indian market is recovering back, and the stock markets are also showing signs of resilience and strength. Economy is showing signs of recovery and green shoots. More companies have been incorporated during this period compared to last year. Now the question is, how the investors would and should behave in uncertain situations that have arisen after January, February 2020. Now the traditional theories would assume that the market players and investors are rational in taking all their economic decisions. The reality could be often different. We all know that the decision making is often influenced, and at many times we have seen are influenced by biases and the errors which are induced by market players, or could be cognitive errors because of our own behavioral patterns. And here the role of behavioral economics, behavioral finance is of importance. Friends, there are acts and rules governing the investments and protection of the right of investors. However, still we hear the stories of people of being duped. Why? Because certainly the companies and the firms, through their unsustainable and attractive schemes, lure the investors and the common people who want to be part of the market, who want to be part of the financial market on the whole. Second, an important aspect would be the case where potential investment itself is impeded due to lack of financial education and literacy. Here, concept of financial inclusion would come in. As we all are aware, the Reserve Bank of India released its National Strategy for Financial Inclusion. and has also set forth the vision and objectives of financial inclusion policies in India. And several steps have been taken to further financial inclusion in the country, like Pradhan Mantri Jan Dhan Yojana, Pradhan Mantri Suraksha Bima Yojana, Atal Pension Yojana. Efforts are being made towards strengthening digital financial services to create the infrastructure to move towards a cashless society. Now, the Government of India's financial inclusion drive, as well as the rapid advancements in connectivity under Digital India Drive, have also led to a rapid spread of the investment culture in India, including in smaller towns and in rural segments. Now, that brings me to the role of Investor Education Protection Fund Authority in the overall scheme. Under Section 125 of the Companies Act 2013, the authority is uniquely placed to settle claims of persons whose amounts and shares are with Investor Education Protection Fund. If not claimed for 7 years from the companies, and also the second role, which is a larger role, to contribute towards investor education and protection. The authority has now entered its 5th year of operations. It was established in September 16, so we can say that practically on working, it would be 3rd, 4th year of its operations. And with brought to 4 functions, as I just mentioned. One is settling claims of amounts, debentures, dividends, and underlying shares which have not been claimed for last 7 years from the companies and which have come to Investor Education Protection Fund Authority. Second, promoting awareness among investors about financial services and products, and ensuring that investors are empowered with adequate information to take informed decisions in the market and on their investment. Expectations are huge, and the authority is making all efforts to meet the challenge. I am happy to inform that in last 2 years, the authority has settled more than 10,000 claims and refunded back shares and dividends of market value of more than 500 crore. I am pleased to inform that also IPFA has managed to rapidly adapt to the changed circumstances and has stepped up its digital outreach efforts. The claim settlement has now been made online. During this pandemic period also, as President ICSI was mentioning, with the help of the company secretaries who are working with the authority, we could settle more than 500 claims and refunded back more than 50 crore during the initial period of lockdown. Now, towards Investor Education Authority has entered into arrangement with institutes like Chartered Accountant, Company Secretaries, and Memorandum of Understanding with Nehru Yuva Kendra Sangathan, Indian Post Payment Bank, CSP Governance, banks like Bank of Baroda, Kotak Bank, ICICI Bank, to spread the message of investor education and awareness. Even during the pandemic, as I mentioned, while the authority continued to settle claims, by adopting various methods through digital medium and also enabling officers to work from home, the partnering organizations also continue to organize investor awareness programs through digital media. IPFA has organized more than 50,000 investor education programs so far. Now, since its inception, the authority has focused not only on furthering the cause of investor education and awareness, but also on developing a robust policy framework and deeper understanding of the issues related to investor protection and investor awareness. Towards this, the authority has come out with a number of policy initiatives during last 1 year. 2 research chairs have been established, one at National Council of Applied Economic Research and other at Indian Institute of Corporate Affairs, which will help tapping the expertise on investor protection related issues. Now, an essential component of investor protection certainly is education. An educated investor is a protected investor. Through our research and awareness activities, we can help investors make and take wise financial decisions and also provide them with the necessary tools and information to guard against malpractices, fraud, etc. A survey conducted by IICA for the authority indeed shows that there is a gap as far as understanding of financial instruments are concerned, and this needs to be filled. A strong movement is indeed required for financial inclusion and investors' education and awareness. I feel many more discussions, seminars, conferences, awareness programs are required to achieve our goal of making every investor an aware investor, an empowered investor, and every Indian to be brought under the cover of financial inclusion. This is important to make India a strong economy, to bring savings into investments, and also achieve the goal of $5 trillion economy, as President ICSI was also mentioned. Today we have experts amidst us who would be discussing this issue, and a panel discussion I think would throw up some issues which would guide the authority, the member, Investor Education Protection Fund Authority, Shri Kumar, is part of the panel along with the expert on the subject, Ms. Monica Halan, Mr. Anil Gupta, and our chair professor at IPFA. Thank you very much for giving this opportunity to speak and also to convey what we are doing, what the authority intends to do, and what all has been done so far. Thank you very much. Thank you.
Thank you, Sri Manoj Pandey, for your special address and letting us know about what has been achieved by IEPFA till date, especially in the area of investor education, and what are its plans for the future. IEPFA has achieved a lot in just a brief period of about 4 years. I'm sure that under your guidance and leadership, IEPFA will achieve much more in future. Thank you once again. We will now start with the panel discussion. We will start with the opening comments and views on the subject from experts and then proceed further on having opinion of the members. So to start with, can we start with the lady on the panel first? It would be great if you, Mrs. Monica Halan, could let us know what you think of the subject. Mrs. Halan.
Yes, thank you. I hope I'm audible.
Yeah, we can hear you. Please.
Okay, great. So thank you very much for the invite. It's a real pleasure to be part of this webinar. And, like in a financial product, the moment of truth of financial literacy is really during a crisis. So if we were to look at investor behavior during the crisis in March 2020, when markets dropped by 30% almost across 3 days, and then we evaluate how investors behaved, then we possibly would be able to understand whether investor education as it has been done has been effective or not in parts of the market. Now, look, India is a very large country, and it's unfair to, brush everyone with the same brush. But if we are talking of the regulated part of the market, that's really where the work of the authority and the rest of us is, because the unregulated part is larger, and that's really the Wild West. And I think that is the space for criminal law and economic offenses rather than investor education. I think it helps to define what are we working with. We are working with regulated part of the market. When we look at the regulated part of the market, I would imagine that investor education is an ongoing process. Some time back, an uncle was sitting with me when I was driving my car, and he said, your driving is maintenance. What he meant was maintenance is not done once every 6 months. It's done in the manner in which you drive a car, right? So I look at investor education and protection as this kind of maintenance. It's an ongoing process. And the moment of truth comes when we hit a road bump. When we hit a crisis, then we know whether we are effective or not. So that's one part of the direction of my thought, that when we evaluate what we do, I mean, all of us are in the same space. We are in the financial literacy space. We do want protection of investors. All of us want financialization of domestic savings, which are part of, so much in gold, so much in real estate, to a certain extent, even insurance, because, that money really is in government bonds rather than coming into private investors for long-term, say, private infrastructure funding. The way that I would also look, taking off from, earlier comments of Mr. Pandey, that when we think of the behavioral part of the way that we look at markets, it would be very, very interesting to see the authority work in two areas. In the space of investor education. So investor education and regulation are two sides of the same coin. So if both regulation and investor education go hand in hand, I think we get multiplier benefits. So for instance, I know for a fact that in March 2020, when the markets dropped, the mutual fund industry actually saw a sharp inflow of money because the way the product had been sold through advisors, and because of the regulations put in place, and possibly a lot of investor education which has happened over the last decade, investors actually understood that this is a moment to buy. And those who lost their nerves and actually sold, forgetting about their asset allocation, forgetting about their own risk profiling, forgetting all the lessons of investor education, actually sold at the bottom, because then markets are up 40% after that. So this whole close coordination with regulators, I think, is extremely important. And then there is a radical idea, and I don't know what the chair of the authority would want to do with that. But, so you yourself said that markets are not efficient, perfect, and we are not economic agents who are maximizing utility, taking into account perfect information, degrees in law, finance, all sitting in our heads, decoding products, looking at disclosures, which are actually very obtuse. The disclosures don't really tell much. So we are in a buyer beware market. In finance, I think the greatest investor protection will be when we move to a seller beware market. And what I mean by that is the onus of suitable product sales. I'm not saying that investors should make money. I'm not saying that they should always be plus and not minus. I'm not saying any of those things. These are market risks which an investor must take. But is the product being sold suitable or unsuitable? Are you selling a sector fund to a first-time retail investor? Are you selling a regular premium traditional policy to a 65-year-old person who has retired? These are just unsuitable sales. And literacy will always lag the innovativeness of the financial sector. We will always be behind unless we protect, we move the market to seller beware, where, and this is where I think the two chairs which have been created, which are so important, I mean, so much important policy work will, I'm sure, get done through that, is that how do we discuss, how do we decide on metrics of suitability? It's a very difficult concept to actually put down in terms of real, thought maps as to what really is a suitable sale, what is a suitable product. But I think if all the, all the people with the PhDs and all the people who have really done deep academic work were to sit down and think about it, possibly that is one area of work where we think about what is suitability and then draw up metrics and then try and move the market to a seller beware. That's one part. But I think that's a very long fight. A closer thing to do, something again, which IICA and the new NCAR work could also look at, is to set up, labs which look at disclosures. So right now, I have just done some work with Dwara, where we are looking at how could that 81 bond sale with a particular bank have been disclosed better. And we ran a survey and we found that better disclosures deterred people from taking that risk. So possibly, we can open up the way that we look at investor protection from maybe descriptions of markets and products into helping them take better decisions. And, a lot of excellent work has been done, but maybe as we move to new technologies, a new way of doing things, maybe you could think of some of these things that I'm speaking about, which will onboard people onto a new way of looking at even their own finances. I will stop here and hope to carry the discussion on. Thank you.
Thank you, Mrs. Jahalan. Especially the point which I noted is related with how you put it, the investor education and the regulation, both acting in tandem to give the multiplier effect. That is an important aspect. And how we are, in the research that we are carrying out at IICA, we are mindful that while the financial inclusion works on the supply side of financial services, financial education and financial literacy, especially the investor education when it comes to investment, plays very important role on the demand side. How those who want to invest or how those who want to access the financial services, what are the factors that they should be mindful of? So we understand and appreciate your inputs on this. We will give you a few more questions to have your insights from the market and from the economy. In the meanwhile, Mr. Gopal V. Kumar, I would request you to give your initial comments on the subject, please.
Thank you. Sri Manoj Pandey ji, Professor Singh, Ashish ji, Ms. Monica Halan, Anil Gupta ji. It's a great privilege to be here with you today to share my views on this important topic, financial decisions. What is financial decision? Right. Financial decision, if you put it simply, is basically taking decisions about your assets, about your liabilities, about your cash flows. Right. And why investor education is required to take those decisions? Because these are not simple decisions. One of the most difficult decisions is the financial decision. As Manoj ji said, behavioral economics, behavioral finance comes into the picture. It's not easy decision. It's not yes and no binary. There are a lot of factors. And they are important to achieve your short-term and long-term financial goals, meet your financial liabilities, meet your cash flow needs. Right? So financing decision is very important. And education is very important for two reasons. One is that if you want to take efficient financing decision, you need to understand not just the assets, but also your liabilities, your financial goals, and your cash flow requirement. And education is also important for nation building because it gives you confidence to put money in financial savings, right? And that creates capital formation and the growth of the economy. So investor education has got three elements, but most of the time we talk of only one element, that is assets. We talk of return, we talk of frauds, we talk of tax benefits. don't talk of volatility, we don't talk of risk, we don't talk of marketability, we don't talk of what is the intermediation cost and all that. So according to me, when we say education, it has to have three elements. One is that, do you understand your need? The first step is know yourself. Do you know yourself? In my view, as a practice, what I see, people discuss about assets, stock market, bond, debt, but what about yourself? Why you are investing? Where you are investing, everybody knows. And the common parameters benchmark becomes return, safety, that's all. That is important. But what is important and what is the biggest risk is that you don't meet your financial goal. That is the risk. You don't meet your financial liabilities. That is the risk. You don't have the right cash flows, especially during COVID time. That is very important. That is the risk. I'll give you a simple example. Two friends of mine who are educated. When I say educated, they are qualified, MBAs and CFA. In April first week, they took two decisions. One, he sold stocks and put the money in FD. Other one, all our risks are also integrated. We cannot isolate our insurance risk with our financial risk, with our operational risk, with our cash flow risk. All risks are integrated. So when we take any financing decision, we have to factor in all these factors together. These are my opening thoughts, and later on when we move on, we'll discuss other points. Thank you very much for giving me this opportunity for my initial remarks. Yeah.
Thank you, Sri Gopal V. Kumar, for your initial comments. Now I would request Mr. Anil Gupta to share his initial thoughts on the subject. Mr. Gupta, please.
Yeah, thank you. Am I audible?
Yeah, we can hear you loud and clear, please.
Okay, thank you. So first of all, many thanks for inviting me on this very interesting panel and discussion. Before I begin, let me give a small story. It's a real story. As about 6-7 years back, I used to work in a company by the name Infosys, and our infrastructure head, who used to sit next to my cabin, he was a retired colonel from and we used to have our lunch or say sometimes tea together. And one day he mentioned that he has come across, or rather he has been approached by an agent of an insurance company. I'll not name the insurance company here. And the returns are fabulous, something like 12 to 14% assured returns. I said, see, you are a fairly educated person. By the way, by way of qualification, he was a civil engineer and an MBA. And fairly experienced because he has retired from from the defense services. Anyway, I said that it wasn't really possible because I don't think that this is something that you can get from the insurance market, and that to a short return at such a high rate of high rates. Anyways, unfortunately, it so happened that for a few days I was not in the town. I had gone out for some team meetings and other things. By the time I came back, he had the policy with him. So he was talking about that. See, in your absence, finally I got this policy, and this is the return. This is the calculation that they have shown. So I was amazed to look at the calculation, and of course this was full of holes. And then we said, okay, let's talk to the regional manager of that insurance company and find out why they are saying so. And after few props, actually, I would say a few questions, they became jittery and they said, no, this is not like that, that is not like that, and all sort of things. Fortunately, thanks to, like I would say, all the wise people in the room, he cancelled his policy. But this clearly tells one thing which Mr. Gopal was also saying, that it doesn't really matter how educated you are. So these two are fundamentally very, very different things. So it's not that you have done your due diligence, or it's not that you know about it, but still you continue to make mistakes. I don't want to quote another examples. One of my CA friend, he was fleeced on his credit card, and he shared his PIN. Actually, he shared his card as well as PIN. I really don't know why people do it. But having said that, I think some of the answers lie in the way people behave. But before there, I think I'm just trying to expand the horizon of this discussion, because so far we have been talking about investor, and when we're talking about investor, it's about 15-20% of India's population. So since GS also mentioned about financial inclusion, I'm just bringing that lens here. So if you look at 70 to 75% of the entire population in India, they earn less than $10 on household basis on daily basis. And if we really, because we do extensive work with them, and if we work with them, there are two myths that we see actually in whole of the market. First myth is that they don't know. They aren't really aware. Unfortunately for us, this is one of the biggest myths. These people, they know what is that they want to do, how they want to save. They know it actually. It's not that they don't know. And their financial lives are much more complex than our lives, because in our life we have a predictable flow. We have less volatility in terms of our income, versus their life where this volatility and the predictability is very, very low. The volatility is high, predictability is low. That is the first myth that we see. And second myth is that they are not able to use the products or the solution which are being offered to them. What we realize is that this is not as simple as it appears. Rather, the problem is that the product or the solution is not offered to them the way they can consume. I'll give you an example. For example, NFT has been there in the market from early 2005, but most of the people, those who were doing remittance in India, they were not able to use it because it was available in a certain way from a certain location. The moment business correspondent they came in India, which are classically banking agents in India, when they came in say 2008, suddenly people started using the same product. So it's not about that they don't want to use it or they can't use it, but if it is not available to them the way they want, it will be very difficult for them to use it. The third thing that we see in the market is that I think for every provider, financial education is the last thing. First, they want to come up with a product or a solution. They say we will follow it up with the financial education. We'll make sure that people understand that. I don't think that is a part of initial strategy, that if we were to do it, that how do we make sure that people are aware about it? So this brings us to one very fundamental question. Are we really doing financial education or financial literacy the way we should be doing? I think so far our focus has been very traditional in the approach, in the sense like we want to make it more like a lecture, we want to make it more like I'm teaching you, so you should be doing this thing or shouldn't be doing this thing. Can we not look at the other option, which are something like what we call it alternate financial education? So some of the experiments that we have done in the field, of course, they have yielded good results, but of course, like a lot of things, these have to be scaled up before one can say it really works. So in one of the case, for example, we work with a set of women, and instead of telling them or teaching them all about it, what we said, okay, let's first think about or discuss about the problem that these women are facing. So instead of again making it more like a lecture-oriented system, which typically say any MFI or a bank or financial literacy council or state council does it for them, what we thought, we create some interesting infographics or interesting pictures and try to generate discussion around that. How does it matter in their life? The fundamentally our belief or hypothesis is that people know that they need to save, and people know this is something that they need to do to protect their future. But I think the problem is that first, sometimes there is a hesitation that can we really save? Do we have enough money to save? And secondly, if we were to save, where do we save? I think these things that we are trying to demystify through alternate financial education. I think we need to really look at it, look at some of the new approaches which are more based on the behavioral based thing. Because just it reminds me one of the famous quote of Dan Ariely. He's a famous behavioral scientist of the state of say Richard Thaler. So incidentally, actually, he's a workshop, and I was part of one of the workshop. He always quotes one example. You see the packet of cigarette, and 60% of that it has a statutory warning. Smoking is injurious to health. People look at it, still they smoke. So education is still there. Education is there. People are aware. Still, people are doing the same thing. So there is something else that we need to do, and we really need to explore some of the alternate options. I think I'll end with that.
Thank you, Mr. Gupta, for your initial comment. Quite a few important aspects have been brought out related to financial behavior. So on this, Mr. Jhalan, what do you think can be helpful in a situation like this? From taking a cue from your book, do you think that this corona crisis has brought out more significantly the aspect of budgeting and saving and just in general being more frugal helps? What do you think about it? The financial behavior aspect, especially related to saving and budgeting.
Yeah, so I think for across the board, the corona crisis woke up a lot of people because, if you look at the people in their 20s and 30s, early 30s, they have only seen a side of India, people who are in organized sector jobs, which people like us who grew up in the 70s and 80s did not see. We've grown up with scarcities, we've grown up in a socialist economy which was supply starved, but they have not seen that, they've only seen plenty. So I think for that generation, it was a real wake-up call. And even for people who had leveraged their incomes to take on a lot of debt, we've seen the behavior change. And if you look at RBI data, there has been a rush to safety. People have redeemed, gone towards fixed deposits, and they have paid back a lot of their debt. So yes, it was a big psychological shock to a lot of people because some people lost jobs, you had reduced incomes, and people who were either not aware or not following the basic tenets of sensible financial planning, budgeting, maintaining this ratio of not having loans more than 30% of your take home, for instance, not spending more than half of your income on necessities, comforts, luxuries, and not saving at least 20% of your take home. People who violate these, especially towards spending and taking on more debt, I think it was a real wake-up call. And in a way, it is good because there's a whole generation of Indians who have understood that good times come and there is no guarantee that good times will continue. And we need to be prepared. Right. So traditionally, we've had a high savings ratio. My sense is into saving better. The challenge will be to turn that S into I. How do we convert these savings into investments?
Right. Great. So again, taking a cue from what is a normal understanding and a knowledge, it's often stated that for a worst case scenario, someone should be having savings for, let's say, to manage the finances or expenses for 3 months or 6 months. do you think that a situation like this would have enhanced that period for having the savings to manage expenses?
So 6 months is actually a rule of thumb, which I have also
Right.
advocated in my book. But then depending upon the sector that you're working in, somebody who's in, say, airlines or hotels, somebody who's a single income family, it's always better to sort of overextend that to a year. And I also said that people in their 50s, and I'm talking of people not in government jobs, but the rest of the people who have the risk of not having a job because of a layoff, at least a part of the retirement corpus, by your 50s, you have most of your retirement corpus in place. My recommendation is 2 years of living expenses you should have in a near liquid form, whether it's a fixed deposit or an ultra short term debt fund. You should have that ability to recalibrate your plan in case in your 50s you have a sudden income shock. But for most other people, between 6 months to a year is adequate because you can get back to your feet in some time.
Right. Great. Okay. Sri Gopal V. Kumar, given your experience as actuary and an economist, what do you think about a few aspects of financial attitude that can be helpful in a situation like this? Do you think that people should be more open to now, for example, term insurance policy? And this brings to my mind another issue related to mis-selling of the product, especially the insurance. That often we get to see people buying insurance policies because an agent is coming and selling it to them. Now, why the agent would sell an endowment policy is because he or she gets a higher premium. So, do you think that often these kind of mis-selling is an important aspect when it comes to insurance? And what can be done to stop this?
Very good question, sir. It has been there for a long time. Mis-selling, why it happens? I go back to what I said earlier, right? If you don't know yourself, if you don't understand your need, what is mis-selling? Mis-selling is what you are offering is not aligned to the need of that person. That is mis-selling. I don't need that, I don't require that, and you are giving me that product. So right now, insurance selling is basically distribution-driven industry. It has to be customer-driven. It has to be need-driven. The shift has to be right from intermediaries, from distribution to customer. The customer needs is most important thing. Probably that is not happening. IRDA has taken a lot of initiatives in that. For example, they have initiated this benefit illustrations. A lot of such regulations are in place. Mis-selling has come down now, right? But it is still, it needs to be taken care of. And the first strategy to curb that would be creating education, right? If you have education, that's why if you see education comes before protection, right? If you are educated, you may not require protection. Right, so education is important. So you have to understand many companies in India also. Before they sell the insurance policy, they have a concept of goal finder. Goal finder is nothing but to understand your risk appetite and trying to understand your financial goal for which you are buying this policy. So that has to be made mandatory. Now things are going in that direction. I think with time we can see that mis-selling reduces and we are in the customer-driven market, need-driven market, goal-driven market. Coming to your first question, that what exactly is the risk and all that changing scenario? I think the biggest risk in the time is not mortality risk. As an actuary, I can tell you, is the longevity risk. Risk of death is less severe than risk of survival. If you die, nothing happens, right? You're gone. If you survive and you don't have money, that is the worst situation you will face. And if you see the demographic growth in our country, I think that is the biggest risk. So obviously health is one of the important need and risk, but next to that is the retirement, how exactly you are, investing for your retirement. So these are the risks which are coming up, and mis-selling is very, very thing, because what happens once you are into that mis-selling, it's shaking your confidence, right? You don't believe in that product, and that impacts not just your buying behavior, but the entire industry. And that is what happened. If you remember 2010 ULIP guideline of the industry, why it happened? Because that was required. But after that, since the investors, the policyholders have lost the confidence, it took them time to come back to ULIP market, right? So these things are important according to me, Professor Singh.
Thank you, Gopalji. Mr. Anil Gupta, given your experience from the field of IT and digital finance, what do you think would be appropriate financial knowledge and awareness about tools in general related to digital financial transactions, which could be helpful in a situation like this? What we did recently was we came up with a paper where we found that actually digital financial transactions from government to people, especially on the ground and related to low income, that has been taking place smoothly now. But those people in the low income groups, especially in the rural regions, they are not carrying out so much of digital financial transactions, which could have been helpful in this kind of period of corona crisis, where it's not advisable to go out or have so much of direct interaction. So, do you think that financial education could be helpful in actually imparting education related to digital financial transactions?
So I take it as a two-part. Actually, one part is all about, say, making people understand or making people aware about this thing. And the second is all about availability of infrastructure. So I think both things are there, both things are in play, particularly if I look at this sector of population. Say, for example, we have 1 million plus agents, banking agents in India. Nearly half of them, they are into rural areas. And they provide basically digital interface, I would say digital interface to the people, those who want to do banking transaction. But if we really look at it, how transactions are happening. So typically these transactions are more like cash out transactions in rural areas, and they use infrastructure, an NPC infrastructure, what we call it Aadhaar payment system. So basically it means that they use biometric as authentication method using their fingerprints and withdraw the money. During COVID, actually, some of the work that we have been doing and we continue to learn from them is that there were several issues actually around that. Because the device or the biometric device that they use, if I am putting the finger, next person is also going to put finger on that. So there are chances of contamination. So people were a little concerned that whether we should use it, whether we shouldn't use it. And you know that initially, even this business correspondent, they were not classified as essential services. Of course, it was identified and they were able to provide the service. So this becomes a major type of transition which happened. But if you look at the infrastructure side of it, even since there are two problems in that also. If you look at these type of population, how do they earn? Typically, they are earning in cash. So if they are earning in cash and if they were to spend digitally, it means they have to go through one more hoop. Hoop here is that they need to go to the bank branch or they need to go to a DC outlet and deposit money. So that becomes one of the major barriers. Secondly, even if they do it, let's assume for a moment that some of them they are willing to do it. The second is that if they want to use a transaction, or if, say for example, they want to pay to a nearby merchant, say 10 bucks, 20 bucks or 50 bucks, there is hardly any acceptance infrastructure in those areas. So that really doesn't permit them. So this becomes the second part of it. Third part of the problem is that, see, most of these people, they have been dealing with a physical currency, which provides them a kind of a proof of doing the transaction. And there have been, like, this is what we always say, that if you look at many of the markets outside India also, wherever you have cash and digital coexist, these things work. Say, for example, a person in, say, a rural area, if he or she is sure, she is assured of that cash is also available and digital transaction is also available simultaneously, there is a high possibility that they will move from cash to digital over a period of time. But if one of them is missing, they would prefer to keep cash because this is their habit. And it's very difficult to change habits, and it requires a lot of concerted efforts. And definitely that means we need to stack up our effort on financial education, and not the kind of classical financial education that we do, maybe more like an alternate way of doing it. So more about telling them the process or making them aware about, if they were to say, this is the process to say. If they were to lend, this is the process to borrow. And you need to create those, I would say, not only interfaces, but also the kind of people, those who are able to empathize with these guys, and they're able to really work with them. This is something that we see fairly missing actually in this area.
Right. Thank you. We have come towards the end of our program, but we'll just take one last question. As Gopalji rightly indicated, what is more significant risk, especially going to be in the future, is the risk of longevity. Now, taking a cue from this new risk which has come in front of all of us because of the mortality rate, lowering of the mortality rate. Mrs. Halan, what do you think traditionally we advise, generally it is advised for those retired persons to go for low risk, which implies that low return investment. Now, as we have seen quite a few retired persons, they had invested their money in fixed deposit. Now, because of a variety of reasons, the interest on fixed deposit has been coming down, which means they have lower funds for managing their expenses. So, given the risk of longevity, would you advise that there should be change in the investment structure even for those who are retired to enable them to get more income in future?
Yeah, absolutely. You cannot be not invested in equity. So when people ask the question, is it a good time to get in, get out? My answer is that you are in equity perpetually. It's only the proportion that you have changes. When you are younger, you have a larger part. At 70, you still have about 30% of your total financial assets in equity. Because of the longevity issue, you have two options in front of you. So either you continue to earn current income. Current income means it's inflation adjusted. And then you can have a risk-free portfolio of fixed deposits, government bonds, or the government guaranteed products, which obviously will give you a lower return. In the absence of current income, if your retirement corpus is small, you have no option but to have a part of your assets in equity. And people, when they hear the word equity, they immediately think of Dalal Street, Wall Street, of speculation. I think we need to understand that investing is not speculation. An equity exposure through an index fund or an ETF is a very, very safe long-term way of generating inflation and tax plus return. So these are the kind of messagings and behavior changing work which will help people onboard equity in the right sense, not looking for doubling, tripling. They should buy a lottery ticket for that, but managing expectations to get inflation and tax adjusted higher returns.
Thank you. With this, we have come to the end of our program. I'd like to thank everyone for insightful views and comments on this subject. I'm sure that the viewers of this program would have immensely benefited from your views. I put on record my thanks to Sri Manoj Pandey, Sri Navneet Chauhan from IEPFA, Sri Ashish Garg from ICSI, Sri Gopal V. Kumar, Mrs. Monica Halan and Sri Anil Gupta as expert panelists on this program. And I would wish everyone to have a successful investing horizon in future. With this, we come to the end of this program. Thank you, everyone. I would also like to thank the team at IPFA and IICA for providing support in this program. I wish you all to have a great day. Thank you.
Thank you. Thank you.